we begin, of course, with oil, which, of course, has been beaten down with all the talk of geopolitical tensions, particularly China, which is the largest consumer of the black gold. $64 for Brent crude in early trading this morning. West Texas barely above the $60 level, and that's just not good for nations like Nigeria, whose benchmark $75. That's, of course, on the front page of today's This Day newspaper, Nigeria's newspaper of record. Natural gas, $3.53. There's an interesting quote from Jim Burkhardt, who's the head of oil market research at S&P Global Commodity Insights. He says the tariffs on China are now higher. That's still pretty significant. Says these negotiations with all these different countries, can the U.S. negotiate with 70 countries all at once? I don't think the chaos is over. And chaos is what we've seen this week. Look at this. The effective tariff on China, if you put everything together from fentanyl to just steel, aluminum, the whole thing, 145% according to the White House. And of course, it was at 50, they climbed to 80. China raising their tariffs. Of course, they were just going tit for tat with the U.S. They've now capped things at 125%. They've said that Donald Trump's tariffs are a quote-unquote a joke. Prime Minister of Spain, Pedro Sanchez, was in Beijing this morning visiting with President Xi Jinping, and he made his first comments on the ongoing trade escalations. Xi Jinping said there are no winners in a trade war, and going against the world will only lead to self-isolation. He also said that China, well, we've been doing this for a while. For over 70 years, China's development has relied on self-reliance, hard work, never on handouts from others, and it is not afraid of any unjust suppression. We will not back down, he says. We're not afraid. He also says, regardless of how the external environment changes, no matter what happens, China will remain confident, stay focused, and concentrate on managing its own affairs. Well, Xi Jinping, of course, proceeding through Southeast Asia for a number of bilateral meetings. And they're also in talks with the EU to take off tariffs on electric vehicles. Get to what's been happening to emerging market currencies like the Naira, closing, of course, at 1,616 yesterday. This is from 1,500 levels. About 10 a.m. this morning, check with the parallel market, it was 1,615. So the Naira has weakened. They ran earlier in the week, falling to a new low against the U.S. dollar. So emerging market currencies have been getting punished, as are Eurobonds. So the average yields for Nigeria's Eurobond, 11.21% as of April the 9th. End of March, it was 9.5. So those climb in basis points. This is not good. When your Eurobond yields are climbing, it means your borrowing costs are going up. And here's the chart here from Nairalytics and the Debt Management Office. Going all the way up is the Eurobonds there. So we spoke, of course, with JP Morgan. They're, of course, on the front page of today's This Day newspaper, talking about the impact on Nigeria with oil prices falling to $60 levels. Gbolahan Taiwo, chief economist for Africa at JP Morgan. Here's our conversation with him.
Thank you very much for having me, Reuters. I mean, where is all this going is a big question. I'm not sure any one of us know where this is going, but I think if you take a step back, at the beginning of this year, the average U.S. tariff was somewhere under 5%. And when President Trump came into power, then you started to see 20% on China, some tariffs on aluminum, some tariffs on autos as well. And that went to about 12% or so. And last week, we had the Liberation Day, the reciprocal tariffs, and then you're talking something around 27%. After the scale back that we had a couple of days ago, maybe it's down to somewhere around 24-25%. The bottom line here is, you've moved from under 5% to 25%, and that is significant in terms of what is going to happen in the U.S. economy and globally as well. This is President Trump trying to reverse, if you like, 100 years of trade here with these trade tariffs and these trade wars. And it's going to have a significant impact on global manufacturing. It's going to have a significant impact on global capex as well. The bottom line of everything is that we are likely heading to a U.S. recession. and more so perhaps even a global recession, depending on the veracity of these tariffs and how long this goes on for. And that's sort of what the markets have started to price over the past 7 to 8 days or so, in terms of the global economy going into a recession. At JP Morgan, before the tariff war started, we had the odds of a global recession somewhere around 30%. And now, as soon as the retaliative tariffs came, we increased those odds to about 60%. Maybe 20% you get only a US recession, maybe 40% you get a global recession. But I think the odds are still higher that you are likely going to get a US recession on the back of all of this, on top of perhaps increased inflation as well. And you probably could be getting yourself into a stagflation scenario in the US, where inflation is higher, unemployment is higher, and growth is lower. And that will again start to complicate decisions for the US Fed in how they react to this. So I think this is the beginning of a lot of things that are probably going to happen. And we just don't know where this is going. But I think what is probably more clearer than most is that there is likely going to be a recession in the US and potentially a global recession as well.
Wow. Now, oil prices. Of course, the JP Morgan is on the front page of today's This Day newspaper. I'm talking about how the impact of declining oil prices will hit Nigeria's current account. We've got oil now below 70. How are you? I mean, it's on the front page, so can you expand on that, basically?
Yeah, so what we did is we tried to estimate the sensitivity of Nigeria's current account to oil prices. The positive thing about what we have seen in the last 18 months or so, and we've seen recently with this balance of payment numbers, is that with the subsidy reform, oil imports have declined. And last year, exports were higher as well. So what we try to do is to estimate at what oil price does Nigeria fall into a deficit. And in our numbers, we think at 60 and below, the current account is probably going to run into deficit. And that is significant for a number of reasons. It means FX receipts are going to reduce. It means the ability of the central bank to continually build reserves is going to be reduced. It means you could potentially see pressures on the currency. It means, again, that the currency could translate into higher inflation. So Nigeria is an oil exporting economy. Close to 90% of its total exports come from oil. So when you see oil prices declining in a meaningful way, then it is significant, and it has a lot of ripple effects in the economy. Fiscal revenues are going to be lower as well. So there's a lot of ripple effect that could come from this. But basically, our estimates show that at $60 oil and lower, then Nigeria probably moves from the surplus position into a deficit position, which then becomes more challenging.
Wow. And I want to get your take on the Euro bonds, because we've seen yields rising, average yields, even on the long end of the curve. Is that, I guess, a fallout from this analysis now, what investors are looking at? Yeah,
I mean, it's a natural reaction to how the market is reacting to the fears of US recession or global recession. So if you look historically, when you have recessions, it always comes with lower oil prices. And for countries like Nigeria, Angola, Gabon on the continent that are oil exporting countries, what you tend to see is that investors tend to de-risk those names. So what you're seeing and the selling on the Euro bonds market is basically investors saying, if we are heading towards a US recession, oil prices are lower because of that. And on top of that, OPEC is saying we're going to start to pump more oil and supply more oil by May. Then there's more downside risk to oil prices. Then I don't want to be holding in Nigeria credits, because Nigeria is very dependent on oil, particularly from FX receipts. So that basically is the reaction that we have seen from investors on the credit side of the Eurobonds, and that's why we've seen the Eurobonds sell off quite a bit. So the longer this gets sustained and we continue to see lower oil prices, and we eventually start to see data that the current account has narrowed and maybe started getting into deficit, my fear is the worse it becomes. Because what tends to happen in recessions normally, if you look at the emerging market spreads between the emerging market, they call it MBIC spreads, between the emerging market countries and the US Treasuries, what tends to happen in a slowdown in economic growth, say for the US, but not a recession, you see that wider by 100 to 200 basis points. In a US recession, that is wider by something around 300 to 400. Now, in a global recession, you're talking 500 to 600 basis points. Now, if we eventually get to that point, I mean, right now we're probably still around 100, but if we get to that point where we actually do have a global recession, Nigeria spreads will probably be wider than it is at the moment, which means the immediate impact is that Nigeria will not be able to come to the Eurobond market to borrow at those levels because the levels will be too expensive to borrow from.
Wow. And I guess this now flows into the currency because we've seen some weakness with the currency falling to the 1,600 levels. I'm guessing this is pass-through effect of that as well.
It is, and well, the more direct, so we talked just earlier about on the credit side, which is the Eurobond. And if you look at some of the balance of payment data that was just released, the central bank is telling us that last year there was about just over $13 billion of foreign portfolio inflows into Nigeria. A bit under $2 billion of that was into the equities market, about $10 billion of that was into fixed income securities. And what we started to see from last week is that some of those flows started to reverse. And that's why we started to see the pressure on the currency. So people started selling their OMO bills or their treasury bills and wanted to exit Nigeria. Again, they wanted to de-risk from these names. And I know what the central bank has basically done is at least manage an orderly exit of the portfolio investors. I mean, the FX is weaker, but we're still talking under 5% this year. It's still not as large as some of the other emerging markets names that you've seen. So I think central bank has tried to manage it in a more orderly fashion. They've supplied the market and they've allowed the currency to depreciate as well. So I mean, if you want to go out at 1,600 or 1,700, you're free to do that. And that's instrumental because if you compare it to sort of what we had under the previous central bank regime, you probably have had a situation where backlog would have started to build and FX is now basically just flat and not moving. But I think the central bank has tried to manage this process a bit in a more orderly fashion.
Now, if I can just piggyback on that, you've already mentioned the balance of payments with that, 6.8 billion for 2024, and then the net reserves that they've released. Can you speak to the transparency of the CBN and this, I guess, for the net FX reserves and your thoughts on the balance of payments growing in the previous year?
No, I think clearly the central bank releasing the net FX reserves position is very transparent, and I think it's good on them that they did that. If you remember, sometimes late 2023, we had published net FX reserves for Nigeria, and we had said it was somewhere around $3.7 billion at the time. Now that we're looking at the published numbers from the central bank, right. it was in line. It fell as low as 3.9 billion. So we're basically in line. But what is more instructive is that the central bank, they've built that from 3.9 to $23 billion in 1 year. Now that's not what you see frequently, and that's very significant. And it's more so significant because it has helped them that's now become the first line of defense for them in now this event of a global risk-off event. Imagine if we're talking about a 3.9 net reserve position and now you have all at these levels and things are saying of they'll probably be in a more precarious situation. To put it differently, what the central bank is saying with the net reserves number is that they have paid down $12 billion of their short-term liabilities over a 1 year period. That's basically what they're saying. $12 billion is significant for you to pay down. And basically, it is the FX forwards that they had. If you remember, when the new administration came in, there was about $7 billion in FX forwards. $5 billion were paid down. There's still $2 billion being contested, but I'm sure that will be resolved at some point. There was a huge amount of bank swaps as well that they needed to reduce. So all of that is what they have done to be able to make the reserves position look cleaner. Another time. On the current account perspective, it was clearly higher exports and lower oil imports. So the subsidy regime helped to reduce imports, and I think imports were lower, double digits year on year. So that was positive, and oil exports were higher because we got higher production, we got higher oil prices as well. So that was good. I think the current account came into somewhere around $17 billion at the end of last year, which is somewhere around 9% of GDP. It is significant. So the overall balance of payments, you add that to your financial account is basically what you get. And what the central bank is saying, and basically it mimics the growth in reserves as well. So we saw the reserves grow by almost $7 billion last year. They say overall balance of payments is 6.8. So I think, again, what we're starting to see is more cleaner numbers, more transparency, even in balance of payment data that we are seeing, more than we are seeing now. And I think all that is pointing in the positive direction.
One more question for you, just to round off. The FDI portion was kind of small. That's on the fiscal side. So we were talking a lot about the monetary side here. What can we do to attract FDI? And then what's your, I guess, because now these global issues now have just put everything into the mix. What's your outlook for the Nigerian economy? Sorry, boy.
I mean, on the FDI side, it's been low, and it's been low for a while. I mean, oil used to be the biggest contributor to FDI, and that has declined significantly. I think oil can still be meaningful, but the problem is, against this backdrop of possible U.S. recession or possible global recession, global capex will come down. So in countries even where you've seen investment announcements, they're now going to be slow. The actual funding are actually now going to be slow because everyone's going to be thinking or rethinking their business strategy in this environment. So that's one that could be a negative. But on the more positive side is that authorities now, the fiscal authorities now have an opportunity to basically go in and create domestic policies that would attract direct investment into different sectors of the economy, not just oil, whether it's agri, whether it's steel and aluminium or what have you. So that again is important. For the overall economy, I think we are very constructive on Nigeria, given the reforms we've seen in the last 2 years or so. We think medium term it is good. We have growth somewhere around 4.5, 4.7% this year. We think Dangote refinery and the ripple effects on the economy would contribute to growth. We think oil production, which we started to see improve, even if it sustains, will continue to contribute to growth meaningfully. And overall, we think the overall economy should do better and inflation should come down. Depending on what happens to oil prices, in the balance of payment should probably still be in a good position as well. But one of the things we haven't touched about, which I'll round up with, is all of these tariff conversations and the impact itself on Nigeria and its exports and whatnot. See, we look at it in two ways. There's the direct impact and there's the indirect impact. The truth is the direct impact for Nigeria is muted. It's muted for a number of reasons. One, Nigeria's trade with the US is very small. So in 2023, for instance, Nigeria exported $61 billion, about $60-odd billion. $6 billion of that went to the US. 90% of that was oil and gas. And oil is exempt. So which means that Nigeria is not going to pay 10%, or now that's brought down to 10% from 14%. It's not going to pay the 10% on the oil. There are little ones like fertilizers and cocoa and whatnot that we still export, but they're tiny amounts. My sense there is that if those are going to be obstructed, then you probably reroute those. So in terms of direct impact, it's not significant. Nigeria's trade with the US is less than 2% of GDP, so I think impact of direct impact will be muted. But the indirect impact is more significant, which is part of what we've spoken about earlier. One key channel there is that even though Nigeria's trade with the US is not as significant, Nigeria's trade with Europe and China are significant. Most of our oil exported to France, Spain, Germany, and whatnot, and also to India, to Indonesia, and to China. So that is significant. If we are going into an environment where there will be a significant slowdown in those economies as well, then you could see aggregate demand reduce, and that could impact. Now, that is still not as big as an impact compared to what then happens to oil prices, like we said earlier. So if we're seeing oil prices decline meaningfully, then you're going to have impact on the balance of payments, you're going to have impact on the fiscal and what the final point, the final channel of impact is on the financing. Nigeria still runs a fiscal deficit, and they typically will want to come to the market every now and then. Again, if we're in an environment where there's a global recession and whatnot, the ability for Nigeria to be able to come to the markets to tap the Eurobond market will be very reduced because the rates will just be too expensive.